Hi, my name is Justin Brown. I'm the Director of Investments here at Greenspring Advisors and lead Greenspring's Investment Committee. Today I'll be sharing highlights from the second quarter of 2025 and offering some perspective on the recent market drawdown and what we can learn from it. Let's start with a quick recap of how markets performed in Q2. The second quarter saw strong returns across all asset classes, with international developed and emerging market stocks leading the way, and U.S. stocks closely behind. All three of these markets posted double-digit gains for the quarter. Bond markets also had a solid showing, with U.S. investment-grade bonds up over 1% and global bonds delivering nearly 2%. It's remarkable to see where markets are now on a year-to-date basis, with all of these major asset classes posting positive returns, especially considering that just 3 months ago, on April 8th, U.S. stocks were down 15.5% year-to-date and in the middle of a 19% drawdown. If you were a client at that time, you likely heard us reiterating that your portfolio is built for times like this. Diversification is your friend, market drawdowns are normal and expected, and most importantly, staying in your seat and trusting in your investment plan is key. With U.S. markets now recovering and up nearly 6% for the year, this is a great moment to revisit some of those key principles we talked about, the data that supports them, and how they held up during the most recent drawdown. The first lesson, drawdowns should be expected. Perhaps the most important mindset shift for investors is to expect market crashes and drawdowns. They're part of the deal. Stock prices reflect investor expectations about future earnings and risk. When those expectations shift, whether from a global pandemic like we saw in 2020 or broad-based tariffs like we saw this year, stock prices can change quickly and dramatically. That doesn't mean the market is broken or that this time is different. It just means the market is doing what it's supposed to do, actively price in new information. So can we or anyone accurately predict when these events will happen? No. But can we expect them as investors and build them into financial plans? Absolutely. Historically, U.S. stocks have had negative returns in more than 25% of calendar years. But even more common are intra-year drawdowns that markets experience. Since 1970, the U.S. market has delivered average annual returns of around 12%, but with an average annual drawdown each year of minus 14.5%. In fact, in 21 of the last 56 years, the market saw a 15% decline. That's once every 2.7 years. When you zoom out, you see these drawdowns are temporary and they're part of the journey. Markets have shown their resiliency over time. The next lesson, diversification matters. Diversification in how you structure your portfolio is crucial to driving long-term outcomes. Periods of volatility often highlight the importance of having diversifiers in your portfolio. This chart shows the year-to-date performance of various asset classes versus U.S. stocks as of April 8th, meaning how much each asset class outperformed or underperformed U.S. stocks when they were at their lowest point. For example, international stocks had outperformed the U.S. by over 13%, and U.S. bonds had outperformed stocks by over 17%. Even though U.S. markets have since recovered, that diversification played a key role in softening the drawdown for investors. For those making withdrawals at that time, it added crucial flexibility for them to be able to take money out of their portfolio without having to sell out of stocks at the bottom. So while headlines focus on U.S. market declines and specific stocks, diversified portfolios like those we built at Greenspring told a very different story. The next lesson, emotional decisions can derail long-term success. The decisions you make during periods of volatility can have a lasting impact on your financial success. Let's go back to April 8th. Markets were at their lowest point of the drawdown. Imagine two investors. Investor A ignored the headlines and stayed invested. Investor B panicked, sold out of the market, and then regretted it, buying back in the very next day after the market had rebounded 9% on April 9th. Investor B missed just one day, but it was the best day of the year. That one day made a meaningful difference in returns compared to Investor A, who did nothing. History shows that the best and worst market days tend to be clustered. Timing your exit is hard, timing your re-entry is even harder, and the odds of missing the worst days while still catching the best ones, extremely low. Mistiming just a few days can have a major impact on long-term outcomes. So what can you do now? With markets back in positive territory, the memory of the drawdown is still fresh. Now's a great time to pause and reflect. How'd you feel during the drawdown earlier this year? Did the volatility make you overly anxious or cause you to lose sleep? If so, it might be a time to explore a more conservative allocation if it still helps you reach your goals. On the flip side, if you felt confident or even excited to invest more, you may be in a position to take on additional risk. Either way, this is a great opportunity to reconnect with your advisor. Let's revisit how your financial plan is built to weather different environments and ensure it aligns with both your goals and your comfort with risk. The bottom line, drawdowns are a normal part of investing. And while we know that intellectually, they still feel unsettling in the moment, especially as they're typically accompanied by scary headlines, uncertainty, or major global events. What matters most isn't trying to avoid them, it's having a plan for them, responding thoughtfully, and designing portfolios that can hold up through difficult times. History continues to show that patient, disciplined investors who stay diversified and stick to their plan are rewarded over time. If you'd like to review your portfolio, revisit your plan, or talk through your investment strategy, we're here to help. On behalf of the investment committee at Greenspring Advisors, thank you for your time today. As always, don't hesitate to reach out with any questions.